and everyone can see me. Cool. Okay. When I started trading about 25 years ago, 1988, I think, was the first year that I was in the market. Mr. Boyke, what is HC? Would that be help, perhaps? The biggest number that was out was the international trade deficit. It came out on a Friday afternoon. We used to call it New York Fridays because it created absolute havoc in the markets, far more than now. That could be right. I think I do better with HotCom because at least over 2 years I got used to it. Perhaps technological adaptability is not one of my strong points. And that's okay. I know it's a joke. It's perfectly okay. But it's actually pretty funny because, as everyone, as I said, who goes to my webinars knows, they rarely start on time. Then again, anyone who knows me knows that almost anything I do rarely starts on time. So again, I do apologize because you people all take time out to listen to this and to sit down and to turn on your computer and pay attention. And for that, I am grateful and I thank you. So 25 years ago, the biggest number was trade balance. In fact, it was a new idea at the time, which is why it was so shocking to the traders and the markets that the U.S. would run a deficit. Up until that time, the U.S. had run enormous trade balances for all of the years since the Second World War. Now, there's an interesting corollary here. I'm sure if you're in the United States, you noted that the Michigan just passed a right-to-work law. Without saying whether this is good or bad or not, the unions, of course, and the workers, and I have belonged to a number of unions in my time, in my earlier days, are trying very hard to prevent the erosion of their wages, of their pensions, of their working power, of their working life. The contracts that the unions, and there's a very strong correlation to this, so just stay with me. Their contracts, now no one likes to have to give back money, so once you reach a certain level in your pay, you expect it to stay there until you retire, at the very least. But the union, I'm speaking specifically of the automobile unions, they gathered these benefits, pay, pension, medical, during the heyday of the American auto industry, from the Second World War probably till about 1975 or so. Things started to become difficult around 1975, 1980, after the first Arab oil embargo on the 73 war in the Middle East in 1973. What they had gathered in, without realizing it, were the fruits of a monopoly position in the industry. After the Second World War, the United States was the only remaining whole, untouched, undamaged, unravaged, unbombed, and unexhausted industrial power in the world. I read this was actually part of a column in the Journal. And I think the way they phrased it was Germany was rubble, Japan was a cinder, and France and Britain were exhausted. This is true, without question. So what seems to the union members now, an erosion of their working power, of the value of their power, is in many senses a falsehood. Because the only reason they could ever gain that type of power, that type of remuneration, was because of the monopoly power of the United States economy for the generation after World War II. The generation after World War II is exactly the story of this chart. Now, the reason this stops in 1992 is because this is a Bloomberg chart, and I can't get any more information on this particular chart before 1992. But in fact, I remember very well when the trade numbers came out, sort of the shock. It's almost as if, as Americans, it was a shock. We were just traders. very junior traders at the time. But it was the first time that you started to get trade deficits in the United States. Part of the reason, of course, is the change and the assertion of OPEC in 1973 and the ever-rising price of oil. But not only that, of course, it's been the exhaustion, until recently, of the U.S.'s own oil. The U.S. is the greatest user of petroleum products in the world. It remains so. I believe 25%, but I'm not sure if that's exactly right. And those play a large part in this balance of payments. Okay, now we're going to look at another chart here, okay? Okay, now, first we're going to look at imports. Okay, these are imports. You'll see something interesting. This is imports. Look at the way the imports change. Of course, you can look at all of this, right? These are value of imports per year. Okay, so look at the slope on this line. Now look at exports. Okay, it's a very similar chart. Slopes are the same. The problem is that starting in the early part in about 1990, the acceleration in the slope, and you started to get a divergence between imports and exports. From, let's show this again. Imports here. You take this line, a gradual. Now, if you're looking at a line like this, right, what can you think? One, population is growing, so imports are going to rise. But what is different is the slope of the line, right? This is a line that goes similar to population growth. I didn't check it absolutely, but it's pretty good. But right here, something happens. Look at this. 1998, 1999. The slope of the line steepens. That means that it's not as in the stock market where the economy grows, the stock market gets bigger. I mean, we all know that. That's the biggest logic behind the increase in the Dow or any other average. It's that the size of the economy gets bigger. The population gets bigger. It's one of my favorite topics, as you know. It's what happens when you get an industrial economy where the population is actually declining. Guess what I'm talking about? Of course, I'm talking about Japan. Japan just elected a new government, a new old government. They put the LDP back in power, mainly because they had no choice. The DJP or DJP was in power for 3 years. That's the first time since the Second World War that the LDP was out of power for any substantial amount of time. And what is the policy of the LDP? It's to print money. It's like bankers these days, central bankers, are completely out of ideas. The only idea that they have is to print money, to weaken their currency. This sounds very mercantilist, actually. Problems are twofold. One, for Japan, they've been trying this policy for almost 20 years. It most assuredly has not worked. It's not going to work this time. And two, the structural problems in Japan are simply not being addressed. And as is often the case with governments, when they run out of ideas, they look for external enemies. And luckily for Japan, and I'm being sarcastic here, China is cooperating. China is making moves. You know, I'm reading an interesting book called 1421 by a man named Gavin Menzies. He made a big splash about 10 years ago. In it, he claims that the Chinese, under I think the third Ming Emperor, about 1420 or so, sent these enormous fleets around the world to circumnavigate the world, that they reached the United States and many other countries long before Columbus, although, of course, the Vikings were here around 1000 in Newfoundland, I think. But the point being that the Chinese had long considered, historically, that area of the South China Sea as part of their domain, part of their area of influence. For the Chinese, the recent weakness, say the past 200 years, is a historical anomaly. It's not their history. And the idea that Japan would be a more dominant naval power, yes, you're correct. I haven't read the book. You're right. So I don't know. It's interesting. I have not, as I said, I'm only started the book a couple of nights ago. I'm waiting yet to get through it and see what kind of evidence he does supply for this idea that the Chinese sent fleets around the world in the early part of the 15th century. Now, at the same time, it's not an impossibility by any means, because at the same time, there's a very strong documented proof that the Chinese were trading on the monsoons from China all the way around to the Persian Gulf and the Red Sea. And that's well documented, that the Chinese junks and shipping from mainland China dominated that trade. So that much is true. And don't forget, at the same time, the Portuguese were heading east down the coast, the western coast of Africa, when to about 1450, if I'm around there, when they actually came across the Cape of Good Hope and came up into the Pacific, or that's the Indian Ocean, actually. Anyway, so back to trade. The Japanese government, the new government under Shinozi, I can't pronounce it, Abe. They're one line. They're two election ideas. Or one, get the BOJ to print more and more and more money and weaken the currency. The second is to strike a more nationalistic tone against China, and China in the South China Sea and some of the Senkaku Islands. The Chinese call them something else. Neither is likely, in my mind, to be terribly successful. The problem with Japan is not so much, although yes, it is certainly true that 80 and 85 to the dollar on the yen is difficult for them to compete. On the other hand, didn't Toyota recently take back the title as the world's largest auto producer? So somebody is, I thank you for that. I'm not sure I could talk that much, but then again, some people who know me, including my children, say that I probably can. They just took back the title as the largest car company in the world. In addition, take a look at Japan makes and still makes many products that are desired by the rest of the world, as does Germany. Mercedes are expensive. BMWs are expensive. VWs are expensive. But they have never had any problem selling them, whatever the euro does, because the products are in demand. The bigger problem for Japan is if you think about consumer products, consumer innovations, when's the last time Japan had one? It might be the Walkman, God help us. The Walkman was originally a cassette-based sound player. I mean, I was not quite in college, but I remember when it first came out. It's 25 years ago. It's before I started working. Japan doesn't really had a product. The entire smartphone, Apple-based, Apple-like technology developments have all come from the United States. They haven't come from Europe. They haven't come from Russia. They haven't come from China. They haven't come from Japan. They've come from the United States. There is actually an interesting development in the area of technological development, and that is the Iron Dome system that the Israelis have deployed. The United States has tried to develop an anti-missile missile system for 20 years, more, since the Reagan administration. The Patriot system that the Americans developed did not work very well and doesn't work very well. The Israeli Iron Dome system works. They built it in about 4 years. Now, part of the reason for that is probably they're using a much newer set of technologies. They're not trying to graft onto existing technologies. They started from scratch. It's like when they finally retired the U.S. space shuttle. Any computer, probably any iPad, perhaps any phone that you're using now, certainly if it's an iPhone, has more computing power than that space shuttle. That's a thought which reminds me of, or indicates sort of the difficulty that the Japanese are having. It's not so much that the yen is too strong, although yes it is. It's that they have ceased to innovate and bring products to the market. That's the biggest problem. The Germans have not. German improvements in cars, in industrial technology remains. SAP is one of the largest software houses, industrial software houses in the world. That's a German company. So the Germans have had a different approach. But 10, 15 years ago, Germany was actually known as the sick man of Europe. But what did they do? They reformed their economy. They reformed their labor laws. Germany has a birth rate just about as low as the Japanese, not quite. Almost all of the European, you've heard this from me before, and almost all of the European countries have a far less than replacement birth rate. The Japanese started earlier, and the Japanese take no immigration. So their population is actually falling. So it's not because, in my mind, of a aging population, innovation generally being a province of the young, not the old. So it's not a problem of the difference in population. I believe it has become. I believe Toyota just reclaimed that title. I believe so. Like last week, I think I read it. I own a Toyota myself. We own a RAV4. Very utilitarian car, very good car. Although my wife doesn't like it too much. So the difference between Germany and Japan is not one of population. It is a difference in attitude. The Germans reformed their economies. They reformed their labor laws, and it worked. Japan has not. Japan has an incredibly protected economy. It still does. The amount of money that the government spends on subsidies of rice farmers, just as an example, means that there's a tremendous misallocation of capital. It's nostalgic. It is, as they, I think, view it, part of the Japanese psyche, part of the Japanness of being a Japanese. By the way, there's a very good book called Looking for the Lost by a man named Alan Bloom. He's an American who went to live in Japan. He unfortunately died very young of cancer. I think he was in his early 40s. But the book is about looking for remnants of the older Japanese culture, which has many astonishingly interesting and beautiful values. The book was written recently, probably in the late 90s. I myself have never been to Japan. Maybe it's time I go. At any rate, back to trade. So we have this difference here. In the late, right here, I actually wrote a post on our Facebook page about this last week, which is what this webinar is actually based on. This period right here, from 98, the real inflection point seems to be right about here, probably early 99. The change in slope, that means imports accelerated. For whatever reason. I don't know exactly why. Probably because those were the last years of the Clinton administration. What happened in the United States? We had a great economy. It was a budget surplus. Has anybody fallen off their chairs? A budget surplus. Not 15 years ago in the United States. Here. All of that seems to have gone into this acceleration of purchasing. We had a recession, of course, and it fell off. But when it resumes, look what happens. This is what I find very, very interesting. Because, remember, our economy is 70% or more consumerism. This is a sociological phenomenon. Because what's happening here is that people are consuming more. They have changed their consumption patterns. And look, it doesn't go back. After the recession and the dot-com bust, the slope on this line here is the same as the slope on this line here. It's not the slope on this line. This just reeks of a bubble economy. The slope gets steeper and steeper, and then it crashes. And here we are again. Now, this recovery right here, in my mind, doesn't count very much. Because all this is a recovery from, a year of denied consumption. People don't buy cars. Eventually the cars wear out. They have to buy a new one. And they're not buying because they don't have money. They're buying, yes, I'm going to talk about that in a minute. They're buying because they were worried. They stopped buying because they're worried. So this resumption right here is not. Now, this is not indicative of anything right here. But these two slopes are what drove the trade deficit on an ever wider percentage. Take a look at exports. Okay, there's exports as well. If you look through here, exports did not, and I have these figures, actually, they're on our page. Exports did not rise the way imports did. Exports kept along the general path, right? This inflection point right here, there was a great divergence. Exports rose, imports rose at 2 or 2.5 times the rate during those 2 years of exports. Now, when we go back here, let's take a look again. This, again, remember, these are exports, okay? It's the same chart, basically. And here, where's exports? Exports. Imports. Okay? You can see the same chart. I don't think I can get them up at the same time. I apologize. I should have put them in the same chart. That way we'd get a better comparison. But what's happening here is this. The base that we're starting at here, even if we ignore this, now I think this is emblematic of a change in the culture, because it's resumed here. The question is, I make the comparison back to the Depression, and I've spoken about this before. My parents never invested in stocks, ever. I have my father's holdings. His entire portfolio consists of about 40 shares in what's now in the United Technologies, because when he was working post-World War II, he went to work for a company called Norden Laboratories. They were actually a defense, what was in those days was not called a defense contractor, would be today, making the Norden bomb sight, which is what the American strategic bombers used during the Second World War, the B-17s, the B-29s, and the B-24s. I don't know if we gave it to the British. I think we didn't. As an employee in those days, he was given stock, and that stock has split and done many things over the past 50 years, so I now own about 40 shares of United Technologies. They owned no other stocks. Their investing attitude, if you could call it that, was formed by the Depression. So what we're looking at here in this period right here, we have this acceleration here. We have a brief where imports, people start buying, you just start buying more. Changes here. Here we go back to, Goodrich was an American company. Here we go back to the same slope. Here we have this great drop. Here, right here, We have people just replacing things finally that they weren't buying during this period right here. Then, look at this slope here. It's very difficult to tell quite what's going on here, but it appears that the consumption pattern, and that is, I'm using the slope of the line to portray the consumption pattern or the degree of consumption, seems, briefly, now we're not sure, here we're getting a fall, to have gone back to this period here. And if that's the case, then if we can change the export side, or in fact, part of this I'll talk about in a second, the import side, having to relate to petroleum, then we will have brought this under control. But the reason you have an ever-widening trade deficit is because this rate of increase, they're operating, when you compare this, so right now we're at 222, right? But back here, say at 100. We'll take this inflection point right here on mid-99 these are imports. Okay, let's look at exports. Mid-99 exports right here. You get the same point of inflation. The problem is, if you get the same rate of increase, but on two different bases, you get an ever wider divergence. If imports are increasing at 10% a year, and you start at 100, the next year there's going to be 110%, right? They're going to be 110 units. But if you're starting at 80, as you do more or less here in exports, the next year it's 88. So you went from a 20-point difference to a 22-point difference. And that continues to expand because you're not, and this is mathematical, or in my case, arithmetical, since I don't do math. And this is the real source of, this is one source of the ever-widening trade deficit. You're operating on a different base, and if you don't change the parameters, you don't change the rate of increase of both sides, the trade deficit, if you don't change the consumption patterns or the export patterns or the import patterns, you will necessarily get an ever-widening trade deficit because they started out unequally. Okay, now. Okay, let's talk about some of these questions, some of these comments here a little bit. Okay, let's put the general number back up. Hold on. Okay, this is the actual trade deficit. And you can see what's been happening here. Now, this is actually a widening deficit because you're using it as a deficit, not the absolute value. I always love that term, absolute value. It's about the only real mathematical term I can ever deploy and use successfully. You can make arguments. If you look at this deficit right here, I mean, you can see how the slope changes, and this is exactly what we're talking about. You have this here, and then you have this acceleration in the deficit. What's also going on in this period right here? It's not really a class. I don't mean to ask a question. It's loose credit, especially in this period right here. That's the Greenspan put on the economy. Flooded with credit post 9/11. This is what it produced. It produced a lot of pointless consumption. Pointless in the sense that it wasn't productive. I mean, one of the arguments that economists will always make, that the deficit isn't harmful, they're twofold, really. Credit, absolutely, I agree with that. And this is why, I actually sent an email to one of the guys who does our investments, my personal investments, family investments these days. It used to be personal, now it's family. And I asked about some of the parameters about, say, investing in Swiss national bonds or something like that. And the reason I asked, now I more or less know the tax treatment because I've worked overseas quite a number of times, was that the type of devaluate, it seems to me that the Fed and its credit policy has no other, just like Japan, just like practically everyone except the Germans, is out of ideas. Print money. It's the only idea that anybody's got. Print more money. And when that doesn't work, print more money. We now have deficits, and not just deficits, but zero interest rates forever. Now, an economy, a capitalist economy that works on price signals, the cost of money is a price signal. And if the price signals are distorted, then it is guaranteed there will be misallocation of capital, just as anything else. If cars were suddenly $10 a piece, we'd all buy cars. We'd all have 6 cars, 8 cars, 20 cars. Would it end up being a good thing? Of course not. There'd be too many cars on the road. I live in Manhattan. Couldn't get gas, on and on and on. Would it make any sense? No. But prevents that. Prices aren't $10. Cars aren't $10 a piece. Exactly the same thing is going to happen, has happened with the cost of capital. It would seem, now I saw another counter-argument to this, that the problem, what Bernanke and others are trying to do, one, I think what's happened here is that they never thought that we would be at this stage 4 years later. His training, of course, as we all know, and analysis is in the Great Depression, and we now have the Great Recession. But the Great Depression, the Fed was too tight. Now, whether you think that Roosevelt's policies when he was elected in 1932 have helped or hindered, the fact is that the government was active. Many would say hyperactive, but it was active. Structural changes were being made all the time. What did Roosevelt call it? Constant innovation or constant experimentation. So the government side was active. Many of the things they tried didn't work. Many of them did. The government now is not active. Not active in the sense that what Roosevelt was trying to do was to revive the economy. In my analysis, President Obama is trying to do things and within what he wants to accomplish, but one of them does not appear to be reviving, making the economy grow faster. He has other criteria and other things that he wants to do. So although the Fed put through an anti-depression loose monetary policy, I don't think it thought they thought that it would have to be in place for so long. But in fact, there have been no changes in the economy and no innovations, no policies to promote growth. None. So they're stuck because the economy isn't strong. The economy hasn't recovered. I'm sorry, but 2% growth, 1.5% growth, whatever we get in the fourth quarter, is not strong growth. It's terribly weak growth. The reason the unemployment rate is at 7.7 is because people simply dropped out of the looking for jobs. So does that mean, what does that mean for Mr. Bernanke's new 6.5% level? Does that mean that those people have to stay permanently out of the job force? What if they start returning? So there are lots of problems with this. But I think the Fed is in a box because I think it's absolutely true. They're in a policy box. Once they started this policy, they thought it was temporary. They expected it to be temporary, that the economy would, one, revive on its own, or two, would not be hindered or would be aided by the government to revive. That has not turned out to be the case. Now, I'm not trying to pass judgment on policies, but it is a fact that the economy has not recovered anything like what's necessary to bring down unemployment. So the Fed's stuck because it's also undoubtedly true now, And the Fed knows forever, it seems, that if it starts tightening or lets tightening happen by stopping the loose money, the economy probably will get weaker and weaker. So the Fed is in a box. There are no structural reforms coming. The only thing that's likely is some sort of mild austerity. In that situation, the Fed is in a box. Okay, listen. The next webinar starts in about 10 minutes. So, I see there are some questions up there. Does anyone have anything that I see Mr. Boyke would like to discuss the fiscal cliff. Absolutely. If you all would like, I will schedule one. I will schedule 2 webinars next month. I only have one scheduled, not till the 24th. I'll be glad to do one before that with FX Street's cooperation, and we can have some fun with this. One thing that I think I would like, you all know that I have pretty strong opinions on things. I'll be glad to do one with a basic start, or if you want, we can actually put up I think I could do this at FX Street, where you can suggest topics, and I will be glad to talk on them for 15 minutes each if we get some votes or something like that. I've done this before with some of our IBs, and people voted. I mean, I think I did one about 2 years ago, or maybe last year, with some of our IBs in China, and the topic that they wanted to talk about most was the U.S. deficit, which I found fascinating from a mainland Chinese point of view. So if you'd like, I'll be glad to talk. Well, let me give you one brief item on the fiscal cliff. Never listen to the media, because the fiscal cliff is largely nonsense, and its effect on the economy is largely going to be nonsense. Look, first of all, everyone assumes they're going to come to some sort of agreement, and they are. But the long-term path of the American economy is going to have to be some sort of mild austerity on spending. There isn't any choice. So the idea that Keynesian stimulus is going to revive the economy is as plain as day not true. So as soon as they sign their agreement, whatever they sign, all of us trading in the markets are going to have to return to the view of the economy. How strong is it? What's likely to happen? Where is it in comparison to Europe? And what's the likely prognosis for 2013 and beyond? Based on that analysis, it's difficult to get very sanguine about where we're going, about unemployment, about economic growth. Because growth has to come from somewhere. You know, yes, the Chinese have, a couple of $1 trillion in surplus that they've amassed over the past, 20 years. What can they do with it? Well, they could employ people, which they have been doing, to produce all sorts of things which aren't bought by anybody. Houses, construction, cars, all sorts of things. Okay, how long can you do that? You can't do it for very long. So until the world is able to revive, you're not going to get a great deal of change. This idea that governments can sponsor economic growth through spending is no longer true. It's true that when you reach that in a normal debt environment, in a normal business cycle environment, yes, government spending can when people are still basically confident, they basically have jobs, and their views are basically optimistic. At that point, yes, in that situation, government spending can function countercyclically. But we're not in that situation. The problems with the economy and with the jobs are not ones that can be revived through government spending or through printing money. Do we need, there is a benefit to trying something because then you actually have the evidence. There's no better evidence on the fallacy that interest rates are a dominant force in the economy than Japan. Japan has had zero interest rates for nigh on 20 years, on and off. They're in their third recession, I think, in the past 5 years. I could be wrong. It might be the second. Interest rates can't do it. Interest rates are the only tool that, put it another way, the success of central banks since the early 80s in fighting inflation seems to have provided central bankers with the idea that they are the dominant force in the economy, that their policies can create all sorts of things. Hubris is a very common human failing. The more powerful you are, the more you seem to be subject to it. Central bankers cannot make the economy run. Interest rates don't make the economy run. They're facilitators at best or problematical at worst. But the bankers around the world seem to think that their interest rate policies can make people do things. This is nonsense. It's not true. And we can see in front of us that it's not true. The same is true with spending, government spending. There are many situations, and in a way, a lot of the things that the government can do are negative. In other words, if the government prints too much money, you're probably going to get inflation sooner or later. I believe that. On the other hand, the government, by jacking up interest rates, can control inflation. Okay? Spending. Right now, if the government withdrew a great deal of spending, it would probably cause a recession. Everyone expects it. There's simply less demand out there. It's Paul Krugman's famous output gap. But the corollary, the reverse of that more spending creates growth, is not true. And we've seen that. So many of the things that the government can do are really negative. This is one of the arguments against an overly activist, a government that gathers more and more of the economy to itself. The libertarian argument, of course, is that government doesn't create anything. Government doesn't. Government can't create wealth because remember, we all have many, many, many more things than my parents had. There's more wealth around. And it's sort of the mystery of that creation that government cannot enter into, and why there are limits to government policy and the success of government policy. Okay, I see that I am being enjoined by FX Street. We should all, by the way, everyone needs to welcome Maud Gilson back. She went on, she probably didn't talk about this, and she probably won't like it that I will, but I'm going to do it anyway. She took this most phenomenal trip, hiking trip, for 2 months to a place that I've never been to and would love to go to, Patagonia and the southern part of the continent, with glaciers and mountains and fishing ports. Anyway, she has been away for 2 months, and everyone should welcome her back and thank her for being back. She's a big part of it. Okay, folks, I thank you very much for listening. I will schedule with FX Solution. No, FX Solution is my old company. I now work for Worldwide Markets. Sorry about that. I don't work for it. I'm a partner here. We have a new company. We don't take American clients. That's another disquisition, which I'm not going to go into today. I will schedule a second webinar for early in December. Oh, wait a minute. It's early in December. Early in January. And what we'll do, I'll try and work it out with FX Street so that we can work with questions from the audience. And then I will prepare a webinar on those topics. Again, I thank you very much. Sure. We are simply that's my new company. Our new company, we're many of the people who founded FX Solutions, which has been such a big success. We don't take American clients. If you're going from an American computer, you're not going to be able to get to that website. If you're interested, I can probably give you a workaround or at least show you what it's all about. Again, thank you all very much for coming. I apologize for my technological ineptitude in the beginning. Maybe what we should do is I should sign in at least an hour before the webinar so that I can get through all of that stuff. It's just Worldwide Markets spelled out all one word, www.worldwidemarkets.com. Thank you all very much. Thank you for attending. Thank you, Maud. Welcome back. And we will see everybody early in January. We will put together a webinar at audience request, and then I'll do my best to answer your questions. Thank you very much. Everyone have a lovely day. Wherever you are in the world, enjoy. Take care.